This content is for educational purposes only, not a professional advice. Mastering student loans. What every borrower needs to know. Student loans can open doors to your dream career, but they can also weigh you down for years if you make the wrong decision. The difference? Knowing when to take them and how to manage them wisely. Before taking on any debt, it's crucial to understand your options. When it comes to student loans, there are two main categories: federal loans and private loans. Let's break them down. Federal student loans are provided by the government and offer several benefits that make them the go-to choice for most students. They can be of three types. Direct subsidized loans are for undergraduate students with financial need. For this type of loan, the government pays the interest while you're in school. For instance, you can borrow $10,000 and the balance won't grow during school or grace periods. Direct unsubsidized loans are available to undergraduate, graduate, and professional students, regardless of financial need. The key difference with subsidized loans is that the interest accrues while you're in school. For example, a $10,000 loan at 5% interest will add about $500 in interest yearly if unpaid. Lastly, there are PLUS loans, designed for graduate students or parents of undergraduates. They usually have higher interest rates, so compare them carefully with private loans before taking them. Other key aspects to know is that federal loan amounts have limits that are set annually by the government, and they offer flexible repayment plans. If federal loans are either not enough or not available for you, then you can turn to private loans offered by banks, credit unions, or online lenders as an option. But even though they can sometimes fill funding gaps, private loans come with more risks and fewer benefits than federal loans. Here is what you need to know about private student loans. They usually have higher interest rates. The interest rates can be fixed or variable. Variable rates might start low, but can rise over time, making payments unpredictable. They have less repayment flexibility, meaning that unlike federal loans, they typically lack income-driven repayment plans or forgiveness options. They require either a good credit score or a cosigner to qualify. In summary, when deciding between federal and private loans, federal loans are usually the smarter choice due to their lower costs and greater flexibility. Only consider private loans if you've maxed out your federal options and still need additional funds. WeFi's mission is to help everybody achieve their financial goals. If you like this video and are looking for ways to improve your personal finances, download our smart app at www.wifiapp.com.